Welcome to the Pump and Dump channel for another video, this time talking about natural gas and then also getting into two stocks for comparison, EQT Corp and Cabot Oil and Gas. And I'm going to talk through, give my take, I guess, on what I see for the upside, the downside, the risk reward for those two stocks in the context of where we are with natural gas price here. So going back to last year, of course, we can just go over this quickly. When I started covering it on my channel, natural gas formed this bearish flag, went into a downward channel. Then around March here, it came out of that downward channel, got into another bear flag, and looked like it was going to go straight back down into another downward channel here. It poked down once or twice here during the summer months when there was basically very little demand, flooding from oil and gas producers who couldn't sell oil, and they had natural gas that they could produce, and they wanted to sell that into the market, and the market didn't want it. And this is kind of where we are at. Is after this bear flag here was broken to the downside, it looked really bad, but eventually it came back in. And I want to just mention here, for like when it got to like $1.40 an MCF, this was really it was looking at a really bearish scenario of like discouraging producers from producing natural gas, telling them stop producing, because the current cost structure is like, for the most part, between $1.50 and $2 an MCF. There are of course some that are a bit above and a bit below, it doesn't really matter, but the market was trying to discourage them from trying to flood it with natural gas because of the fact that they couldn't sell oil and whatever. So also this target made sense from a longer term perspective because of external economies of scale outside of companies themselves, with the advancements in fracking technology and all that stuff. It's kind of leading to a longer term outlook of having most likely around $1.50 to $1.75, I would say, would be a normalized price in the longer term, looking out maybe 3 years or so, 4 years. And that is because of the fact that they're going to be able to drill and produce natural gas much cheaper than they can at this point in time. But we are not there yet. We are still in this phase here where they still have higher costs. Most of these companies, they go out and drill, and they don't complete wells because they have to drill it to keep the lease on the property. Otherwise they lose it, and then someone else can come in and take over that acreage, and then once it's drilled, it's kind of like they're laying a claim on that area, and when they want to bring it to production, they just frack it and then they start producing the oil. So this is where we are at. We have lots of drilled and uncompleted wells that are out there, and their cost structure is like $1.50 to $2 for the most part. And so if we're in a situation here where associated natural gas is going to drop from the oil producers who are drilling less wells these days and completing less and trying to get back the market back into balance after we had several months here of lower production and lower demand. So we have that situation there, those fundamentals, those facts. And now it's really the question of do we need more natural gas production? And that really depends upon an economic recovery. I mean, there's no reason why we are in a crisis right now, in a recession. We shouldn't be. I mean, this virus is not any more harmful than the flu, but politicians are kind of running with it because they can't explain the deflationary bust in any other way. They kind of want to hide that from the population, say like, listen, it's not our fault, we're innocent, it was the coronavirus that caused the economy to melt down. It has nothing to do with the banking system, has nothing to do with those politicians closing down the economy, etc., etc. So what we have there is a case of the economy. If it does come back next year, which is possible, then we'll need more natural gas. So the incentive price has to kind of reflect that. The incentive price is saying, okay, we're offering around 266 right now, it says, but I mean, it's been as high as 275 if you look here on the chart. 275, that is kind of the incentive price for the lower cost producers. And with 275, they'll bring on more production if the market so chooses. And it's not necessarily in the current month, but it's 275. It can also be in the back months, the further out months from where we are now. Like if we look in the winter period, January and so on and so forth, it's looking like $3 an MCF, $3 plus. And so with an incentive price to get the lower cost producers incentivized to produce more, it doesn't necessarily mean that we'll cover all the lost supply from the associated gas, and it might be that we will have to, see prices at $3.50 to incentivize the higher cost producers to also get on board producing more natural gas, and that would, that would be like a reasonable target, 350, in a bullish market. An extreme price could be like $5 an MCF, but I'm not sure we will really get there. And so that's kind of the backdrop here. Now looking at this, translating this into an investment thesis using natural gas producers, looking at Cabot Oil and Gas and EQT Corp. One has to look at risk and reward. So if we look at this company here, it's got about $7.5 billion market cap. It has 1.25 billion in debt and 100 million in cash. So it's fairly low risk, this. I mean, there's no chance they go bankrupt in the next 5-10 years, I would say. And if we look at it from that perspective, it's a good investment, a good vehicle, a good company. Now with the valuation where it should be right now is about $22 a share. That's kind of the valuation I got out. We reached about 21 here on August 10th, and August 10th was when we were running up from this lower band here, when we broke through this green line here, this August 2019 low. We broke through it quite strongly. We kind of set back and started moving higher. We got into this first peak, we pulled back, and then we kept pushing higher towards the higher band. So you can see natural gas price is now higher than it was in August. So the market was pre-pricing the natural gas price going higher with Cabot Oil and Gas stock. But now, as it is higher, the stock is lower because who knows, like maybe people were worried that Powell was going to say something that was going to cause the market to crash, and maybe they're looking at the RSI and they looked here in August, said it was overbought, it's time to sell natural gas and natural gas stocks, so they sell everything. But it kind of remains here in overbought territory, and it kind of pushes higher. It got to this resistance here, and this gap up, that's just the natural gas price, moving from one contract into the other. So this gap up is not like the natural gas price gapped up. It's just like we're moving from one contract into the other, and therefore looking further out into the future, the winter months suggest higher natural gas prices up here somewhere. So we could come back down here. We could even fall back into this range here for whatever reason, but we could also just after falling back down, we could jump back up and get like to 350 here, maybe 11th of February, who knows. So that's kind of the potential outlook here with the price. That's kind of what I'm thinking. With EQT Corp, the fair value I got was $19.39 when I did it before, when I was calculating it. And with this stock here, I mean, it got to somewhere around $18 up here, I think. 17.97 it says is the high of the last 52 weeks. I remember it was on CNBC. There was this guy who was talking about them and other natural gas producers. So this is kind of where it was sold, and now the price has retraced. The value has risen into justifying this price and even more. So logic would suggest to me that we have a good chance of getting towards those valuations at least. I mean, even if the natural gas price drops by a set percentage point, it could, with EQT Corp, because they have higher financial leverage and their operating costs are also higher, so they also have higher operating leverage. It could lead to the upside falling from 19 down to $17, and then you don't have much of a margin of safety between what you paid and what it's worth. But with Cabot Oil and Gas, and this is something to take away in terms of looking at it from risk reward perspective, is that if the natural gas price drops by a set percentage that leads EQT to fall from 19 fair value to 17, it might only cause the fair value of Cabot Oil and Gas to drop from 22 down to 21. So you'd still have a substantial upside. 10% plus would look good. And this is kind of, I guess, what the topic is of this video here, is about risk and reward and seeing things in context. and then hopefully making, you know, better decisions by picking the superior investment vehicle. I mean, obviously you can see here Cabot Oil and Gas is down 0.71%, EQT is only down by 0.25, even though it's more leveraged and whatever. But yeah, this is some thought pattern one has to make when looking at these things. I mean, the RSI here, this has a nice uptrend here that was broken the other day, and it popped up against it and is pushing higher. And we also see here that we have a secondary trend line that we can maybe fall back on. And I think that, you know, given these circumstances, there is just more upside in terms of a risk-adjusted return in a Cabot Oil and Gas than in EQT. So that, I guess, is going to do it for this video. So remember, as probably said before, it's not investment advice or recommendations for you to buy or not to buy these stocks. It's of course always your decision. If you like the video, you can always subscribe to the channel. If you want to leave questions, comments or opinions in the comment section, you can also do so. And with that said, have a good day.